Have you ever dreamed of owning your own home? For many Americans, this dream is moving further out of reach. Imagine waking up one day to find out that mortgage rates have soared to a staggering 8%, the highest we've seen in decades. Just recently, reports confirmed a dramatic spike in U.S. mortgage rates, climbing to this figure. Such an increase is not just a number, it's a significant shift that could reshape the future of homeownership for millions. Just last week, the rates were hovering around 7.24%, and now they've jumped to 8%, according to the latest data from Freddie Mac. What does this mean for the average person wanting to buy a home? And more importantly, why is this happening now? This video will dive into the implications of these soaring rates. We'll explore how they affect you and me, the economy, and the policies that could be steering these changes. By the end, we aim to understand not just the what and the how, but also the why behind these rising costs of borrowing for a home. Historical context. Do you remember when getting a home loan was more affordable? Just a decade ago, in 2014, the average 30-year fixed-rate mortgage rate was around 4.17%. Over the years, these rates experienced ups and downs, reflecting the economic conditions of the times. For example, by the end of 2018, rates had climbed to about 4.55%. However, nothing quite prepared homeowners and buyers for the steep declines and rises that were to come. Let's zero in on a more recent period, the year 2021. During this year, rates hit historical lows, largely due to measures taken to cushion the economy from the pandemic's impact. Rates dropped to an almost unbelievable low of around 2.65%. Many Americans jumped at the opportunity to buy homes or refinance their existing loans at these lower rates. However, the relief was short-lived. As the economy began to recover and inflation started to creep up, mortgage rates started to climb again. By late 2022, they were approaching 7%, and now in 2024, we're seeing them hit 8%. According to Freddie Mac, this steep rise marks one of the most significant increases in such a short period in recent history. Why is this important? These shifts are not just numbers on a page, they reflect changes in the cost of living and impact real people's lives. For instance, the jump from 2.65% in 2021 to 8% can increase monthly payments by hundreds of dollars for the average homebuyer. Bloomberg reports that this kind of increase can drastically reduce the buying power of prospective homeowners, putting the American dream of owning a home out of reach for many. This overview of mortgage rate trends helps us understand the current landscape and sets the stage for discussing the broader economic impacts and policy decisions influencing these changes. As rates continue to rise, understanding this historical context is crucial for anyone trying to navigate the housing market today. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Economic impact of rising mortgage rates. Have you ever wondered how rising mortgage rates affect everyday people and the broader housing market? Let's break down the real-world consequences of these rate hikes from the perspective of homebuyers, homeowners, and the overall housing market. Rising mortgage rates dramatically influence those looking to buy a home. When rates climbed past the 7% mark and approached 8%, the cost of borrowing money to buy a house became significantly more expensive. For instance, a mortgage rate increase from 6.39% last year to over 8% this year can add several $100s to a monthly mortgage payment. This leap can turn what was an affordable option into something out of reach for many potential buyers. The psychological impact is also profound. Crossing the 7% threshold has historically acted as a deterrent, making people hesitant to buy as they wait for rates to drop back down. According to CNBC, applications for mortgages to purchase a home fell by 1% in just a week and were 15% lower than the same week a year ago, showing a direct response to the spike in rates. For homeowners, the rising rates mean refinancing might no longer be a viable option. Those who secured lower rates in the past are now less likely to refinance, as doing so would mean taking on higher interest rates than their current ones. This decision to lock in has contributed to a slowdown in the refinancing market, with applications falling 6% from the previous week, as noted by the Mortgage Bankers Association. Moreover, those who might have considered selling their homes to upgrade or downsize might choose to stay put to avoid entering into a new mortgage at these higher rates. This behavior affects the supply side of the housing market, keeping listings low in many areas and further complicating market dynamics. The entire housing market feels the effects of rising mortgage rates. With higher rates, the pool of eligible buyers shrinks, which can lead to a cooling off of home prices over time. However, this isn't always immediate, as supply constraints can sometimes keep prices high even as demand drops. According to the Wall Street Journal, the current market dynamics are leading to reduced bidding wars and a slowdown in the rate at which home prices were escalating. On a broader scale, as noted by the National Association of Realtors, the sales of existing homes fell by 4.3% in March and were down 3.7% from the previous year, a direct reflection of the chilling effect high rates have on buyer enthusiasm and capability. The impact of rising mortgage rates is complex and multifaceted. For buyers, it means recalculating budgets and perhaps putting off purchasing decisions. For homeowners, it's about deciding whether to sell or stay put. And for the housing market overall, it's a delicate balance of supply and demand, influenced heavily by these rates. As we continue to see fluctuations, the key will be adapting to these changes, whether through personal financial decisions or broader economic policies. Political implications. How do government policies and political decisions influence mortgage rates? It's essential to understand the role of key players like the Federal Reserve and the government's response to these economic shifts. The Federal Reserve plays a critical role in influencing mortgage rates through its control over short-term interest rates. While the Fed does not directly set the rates that borrowers pay on mortgages, its policies significantly affect the economic environment that determines these rates. For example, when the Fed raises its key interest rates to combat inflation, as it has been doing recently, mortgage rates tend to follow. This year, the Fed's benchmark interest rate is at its highest in 22 years, which directly correlates with the climb in mortgage rates to 8%. According to Bloomberg, these measures are intended to cool down the economy but have the side effect of making loans more expensive for consumers. Government interventions can also impact mortgage rates and housing affordability. For instance, housing policies that increase the supply of affordable housing or tax incentives for homebuyers can help counteract the effect of rising rates. However, critics often point out that there has been insufficient action in this area to date. Statements from leaders emphasize the need for policies that do not just react to market conditions, but help create a stable economic environment that supports long-term affordability in housing. Fiscal responsibility and a market-driven approach are often cited as essential for economic stability and growth. Key figures argue for reducing government intervention and allowing market forces to regulate the economy, including the housing market. They might critique the Fed's current policies as overly aggressive, which they claim could lead to a slowdown in economic growth. For instance, in recent speeches, policymakers have advocated for easing regulatory burdens to boost the housing supply and lower costs. Looking ahead, the debate continues on how to best balance inflation control with economic growth. The Wall Street Journal reports that while high mortgage rates can slow down inflation, they also reduce home buying activity, which can drag on the broader economy. This presents a challenge for policymakers who must decide whether to prioritize immediate inflation control or longer-term economic stability. The intersection of politics, policy, and economics in the realm of mortgage rates is complex and often contentious. Decisions made by the Federal Reserve and government interventions, or lack thereof, can significantly sway the cost of borrowing for millions of Americans. As we witness these policies unfold, the key will be to monitor their long-term impacts on both the housing market and the overall economic landscape. Case studies and real-world examples. According to a report by the Wall Street Journal, the rise in mortgage rates could potentially slow down home price appreciation by as much as 3% over the next year, if the rates continue to stay elevated. This projection is based on an analysis of historical data where similar rate increases have tempered housing market gains. Additionally, the same analysis predicts a decrease in new housing starts, suggesting that developers might be anticipating a drop in demand. In Seattle, a city known for its robust tech industry and high property values, the rise in mortgage rates from an average of 3% in early 2021 to 8% in 2024 has had a significant impact on first-time home buyers. According to a study conducted by the Seattle Real Estate Association, the number of first-time buyers entering the market has decreased by 20% year over year. The increase in rates has added approximately $500 to monthly mortgage payments on median-priced homes, which has sidelined many potential buyers, particularly younger adults who are already facing challenges with student debt and rising living costs. In suburban Chicago, an area characterized by a stable middle-class population, the increase in mortgage rates has led to a noticeable drop in housing turnover. Data from the Chicago Housing Authority reveals that home sales have decreased by 15% compared to the previous year. Many homeowners who would typically upgrade or downsize are choosing to stay put because the higher rates make new mortgages less affordable. This stagnation is beginning to affect local housing markets, with ripple effects on home improvement businesses and real estate services. Austin has experienced a different dynamic. As mortgage rates have climbed, more people have been pushed out of the buying market and into renting. This shift has increased demand in the rental market, leading to a spike in rent prices. A report from the Texas Real Estate Research Center indicates that rent prices in Austin have increased by an average of 12% in the past year alone. This situation is creating affordability issues for renters, many of whom are saving to buy their own homes. The luxury home market in Miami, which often caters to international buyers and high net worth individuals, shows a contrasting trend. Despite high national mortgage rates, the luxury sector has been less affected. Research from Miami Luxury Homes Group shows that sales in this sector have only dipped by 5%, as many luxury buyers tend to make purchases in cash. However, there is a growing concern that if rates continue to rise, even this market segment could see a slowdown. These case studies and local examples bring to life the statistics and policies discussed in earlier sections. They show how rising mortgage rates resonate through the economy, affecting individuals and communities in profound ways. Understanding these personal and local impacts helps to underscore the urgency of addressing mortgage affordability and stability in the housing market. As we consider future policies and economic strategies, these real-world impacts offer critical insights into the human side of economic data. Comparative analysis with other countries. How do mortgage rates in the U.S. compare with those in other parts of the world? Understanding the global landscape can provide us with insights into different economic strategies and their effectiveness in managing housing markets. Let's start by comparing the U.S. mortgage rate situation with that of Canada and Germany, two countries with significantly different economic policies and housing market dynamics. As of the latest reports, while the U.S. has seen mortgage rates soaring to 8%, Canada's average mortgage rate remains at about 5.75%. In Germany, the average rate is even lower, around 2.5%, according to the latest data from global financial markets. These differences are not just about numbers, they reflect diverse economic policies, banking regulations, and housing market structures. For instance, Germany's lower rates can be attributed to its strong regulatory environment and public banking sector, which often offers more favorable borrowing terms. In Canada, where the housing market has also experienced high volatility, the government has implemented several measures to stabilize the market. These include stricter lending criteria and a tax on foreign buyers in urban areas. These policies have helped moderate the effects of global economic instability on mortgage rates and housing prices. Conversely, Germany's approach involves heavy government involvement in housing. A large portion of German housing is publicly owned, and rent controls are common, keeping the housing market stable and mortgages more affordable. This is reflected in their remarkably low mortgage rates and stable housing prices despite global economic pressures. The impact of these policies is clear when looking at home ownership rates. In the U.S., where high mortgage rates make buying a home increasingly difficult, the home ownership rate is around 65%. In contrast, in Germany, where low rates and stable prices prevail, the ownership rate is somewhat lower, around 51%, which is partly due to a strong cultural preference for renting. However, this also indicates a less volatile housing market compared to the U.S. This comparative analysis highlights how different strategies and economic environments affect mortgage rates and home ownership. The U.S. might consider aspects of these other systems, particularly in terms of regulatory measures and government roles in the housing market, to address current challenges. Looking at global examples, it becomes clear that a blend of regulation, market freedom, and strategic government intervention could potentially stabilize or even lower mortgage rates, making home ownership more accessible for more Americans. Potential solutions and recommendations. What can be done to address the skyrocketing mortgage rates and make housing more affordable for Americans? As we face these challenges, it's crucial to explore both immediate and long-term strategies that could stabilize or even reduce mortgage rates. In the short term, one actionable step could be the introduction of temporary tax relief for first-time homebuyers. This could directly reduce the initial cost of purchasing a home, making it more feasible for new entrants into the market. For instance, a proposal could include a tax credit that covers a percentage of the mortgage interest paid during the first year of home ownership. This kind of incentive could help counteract the discouraging effects of high mortgage rates. Another immediate measure could be enhancing the government-sponsored enterprise (GSE) programs that support mortgage lending, particularly for lower-income households. By increasing the capital these programs can use to back mortgages, the risk to lenders decreases, potentially allowing them to offer lower interest rates to borrowers. California recently launched a new program called the Dream for All. This program offers up 20% for down payments or a closing cost, not to exceed $150,000. Wouldn't it be great if all states offered this program? For more permanent solutions, there's a strong argument for substantial regulatory reform. Reducing the complexity and cost of mortgage lending regulations could encourage more competition among lenders, which typically leads to better rates for consumers. For example, simplifying the compliance requirements for small community lenders could enable them to offer more competitive rates, benefiting local markets particularly. Another long-term strategy could involve revising zoning laws to allow more home building, which would increase supply and help to stabilize prices. By reducing restrictions on where and what can be built, especially in high-demand urban areas, the housing market could become more responsive to increases in demand, keeping home prices and subsequently mortgage rates in check. The emphasis is on deregulation and promoting an environment where the market can adjust naturally without excessive government intervention. This vision includes advocating for policies that enhance economic freedom, such as lower taxes for property owners and incentives for private sector investment in housing. The government might also push for reforms in lending practices, focusing on transparency and fairness to prevent predatory lending and ensure that buyers fully understand the terms of their mortgages. Encouraging education about personal finance as part of the mortgage application process could lead to more informed decisions by consumers, which in turn could lead to a more stable housing market. Addressing the issue of high mortgage rates requires a multifaceted approach that includes both immediate relief and strategic long-term planning. By implementing thoughtful tax relief, regulatory reforms, and educational initiatives, there's a potential to make home buying more accessible and affordable, aligning with the values of free market principles and personal responsibility. These solutions not only aim to reduce the financial burden on home buyers, but also contribute to a healthier, more equitable housing market. If you are looking to buy or invest in a market where prices are dropping right now, you may want to check out this video next. Thanks for watching.